Thank you for joining us. My name is Eric Lee, and I'm the Sales Director at Philip Nova. Before we dive into today's topic, I want to do a quick sound check. If you can hear me clearly, please type yes into the question box. Feel free to type your questions in the box during the webinar, and I will address them during the Q&A session at the end. Great, looks like everyone can hear me clearly, so let's begin. Please take a moment to review the disclaimer. Today's content is for educational purposes only and should not be taken as a financial advice. Always consult with a financial professional before making investment decisions. A bit about myself. I've been with Philip Nova since 2004 and have more than 20 years of experience in the financial markets. My passion lies in helping clients achieve their investment goals through in-depth market research, chart analysis, and intermarket insights. I believe in continually improving our edge in investing, and I'm excited to share some of those ideas with you today. Today's webinar is packed with valuable insights. Here's a quick overview of what we'll be discussing today. First, we'll define what the yen carry trade is and why it's relevant. Then we'll dive into the current trends in the yen and the Nikkei 225. Examine how the yen's movements is affecting the Japanese equities and explore strategies to give us insights into what the institutional investors are trading in this environment. Finally, we'll look at the outlook for Nikkei and discuss practical investment strategies for investors like yourself. Please feel free to submit questions throughout the presentation, and we'll address them during the Q&A session at the end. During the COVID pandemic, central banks globally adopted zero or even negative interest rate policies to cushion the blow to their economies. As we recovered from the pandemic, inflation took center stage, leading to aggressive monetary tightening, with the Federal Reserve and other central banks progressively raising interest rates. This shift, however, took a different course in Japan. Japan, marred by decades of economic stagnation, remained an outlier among major economies. The Bank of Japan, also known as BOJ, kept interest rates near zero, even as other major economies increased theirs. The growing rate differentials between the yen and other currencies caused the yen to tumble, reaching a 30-year low. Even after BOJ began exiting its negative interest rate policy in March 2024, the yen still continued to struggle against the dollar and other major currencies. As a result, Japanese assets suddenly appeared to be cheaper relative to assets in other economies, reviving interest in them. The Nikkei 225 index finally reclaimed its historic high from some 35 years ago, even breaching the historic 40,000 mark, and set new historic highs, joining the S&P 500 and other world equity indexes in developed countries in setting record high this year. With the BOJ walking a tightrope on managing domestic inflation and economic performance, while at the same time keeping an eye on its currency strength. This set the stage for the market turmoil reminiscent of the infamous Black Monday. So on the 5th of August this year, Nikkei 225 stock index recorded its worst ever daily sell-off on Monday, losing 4,450 points from the previous day's closing, amid panic selling triggered by fears of possible US recession and the yen's strength. It then closed down 12% to about 31,450 points. By percentage, it was the second largest fall since the Black Monday crash of October 1987, when the index lost 3,800 points, but roughly about 14.9%. Stocks have been in a downward spiral since the start of August. That's because a day after the Bank of Japan aggressively raised rates to 0.25% from 0.1%. And not just that, they also said at that time that it was open to more hikes this year. So the hawkish remark really caused the Nikkei 225 to shed 3.5% that day. And the following day, it lost another 5.8% or about 2,200 points. And this made the second worst daily sell-off. To be fair, the market sell-down is not entirely BOJ's doing. Foreign investors were also selling the Japanese stocks due to concerns that US may be heading for recession. Yet, the events that transpired brought the world's focus back to this financial phenomena known as yen carried trades. Now, maybe you are wondering, what exactly is the yen carried trade? In simple terms, it's a strategy where investors borrow yen, which has a low interest rate, to invest in higher yielding assets like the US bond or stocks. And this strategy works when the yen remains weak, as we have seen recently. When the yen strengthens, it becomes more expensive to repay those yen denominated loans. To have a better understanding on the origin of the yen carry trade, we need to take a trip back in time. Yours started back in the 1990s. Japan asset price bubble burst somewhere around the beginning of the 1990s, marking the onset of a period of economic stagnation and deflation known as the lost decade. So in response to this, in response to the deflationary rather the deflationary period that the Japan's economy was going through, the Bank of Japan then lowered its interest rate to unprecedented levels to stimulate economic activity. And these low rates persisted into the 2000s and beyond. In fact, it is only in the recent months that the Japan, the BOJ, finally get to reverse and get themselves out of this low or negative interest rate environment that they have been in for the past 20 to 30 years. So this low interest rate that Japan had been going through provide provide the perfect condition for the yen carry trade to flourish. Investors around the world were drawn to the opportunity to borrow cheaply in yen and then invest what they borrow into higher yielding assets elsewhere, fueling a cycle of global financial flows that contributed to asset bubbles in other countries. As you can see, Japan's last decade was characterized by a vicious cycle of falling prices and stagnant growth. The collapse of the asset price bubble left banks and many companies burdened with non performing loans, stifling investment and consumption. People just don't see the point of spending, buying assets when they know that down the line, the next few years, the prices is just going to get cheaper. So the Bank of Japan's attempt to counteract this deflationary pressure with low interest rates set the stage for unconventional monetary policy measures, including quantitative easing. Prior to this, under monetary theory or financial theory, it is always noted that central banks uses interest rate adjustment to help fight against inflation or to help to spur economic growth in the country. But when interest rate drop to zero at even negative level and still the economy fail to be um, fired up, so then this caused the central banks in Japan to start to look into more measures. So what they do is that they embark on a series of aggressive monetary policy interventions. And these policies include setting the interest rate at near zero and also massive asset purchases to inject liquidity into the economy. But despite these efforts, Japan struggled to achieve sustained inflation or robust economic growth, leading to further experimentation with monetary policy tools, including the introduction of negative interest rate. And from this chart, we can see why this is called the Japan's lost decades. Because after peaking in the 1990s, it took Nikkei 225 another 34 years before reaching its all-time high again. In fact, it's only just this year that it started to trade above the high that it met, that it clocked in 1990. So for years, the place to get money on the cheap has always been in Japan, where interest rates have held steadily at or near zero. Investors could borrow Japanese yen for a small fee and then use that yen to buy, say, like US tech stocks or government bonds like the US treasuries, or to buy other currencies like the Mexican peso, all of which have offered solid returns in recent years. In theory, as long as the yen remains low against the dollar, the investor can always pay back what they borrowed and still walk away with a tidy profit. The yen carry trade especially proved to be especially popular in the last 4 years because Japan was the only economy in the world, or rather only major economy in the world, offering essentially free money. While the US, Europe, and the other Asian economies were raising interest rates because we were all fighting inflation. Japan had the opposite problem. It has to keep its borrowing rates low because they don't have inflation, they have a deflation problem, and they need to encourage economic growth. So, borrowing for next to nothing and getting a 5% return on US Treasury sounds like a no-brainer to a lot of institutional investors. But the problems began sometime middle of this year when the yen's value started going up somewhere around July this year. So when the yen starts strengthening, this will erode the potential profit from a yen carry trade. And on 1st of August, BOJ raised interest rate for the second time since March, pushing the yen even higher and thus making it even more expensive to pay back their yen-based loan. And meanwhile, at the other side part of the world, the US dollar weakened as Federal Reserve strongly hinted at a rate cut, and US tech stocks declined because of some bad economic numbers. Thus, at that point in time, imagine if you are running a fund and you are invested into this carry trade. You have some positions in it. You will likely head for the exits. But the problem is, so is everyone else who had the same position as you. And in theory, carry trades looks like a low risk arbitrage trade because you are simply borrowing from a country with a low interest rate and invest into a country with a higher interest rate, and thus earning the difference between the interest rate. For example, USD and Japan, US and Japan, right? For the past 1-2 years, the US interest rate is 5%, Japan's interest rate is near zero. So that's an arbitrage trade. But in practice, this kind of trade relies on borrowing, which means that it is a leverage position. As a general rule of thumb, whenever you hear the word leverage in finance, it always means high risk. So once even a minor losses start to accrue, lenders are going to demand that the trader pony up with more cash to cover their potential losses. So this process is commonly called margin call in finance. So to counteract against margin call, that will mean that the traders would either need to sell their investment like stocks or bonds to raise the cash, or they will just have to completely get out of the position and return the money back to the lenders. So not everyone will have margin call all at once, because some may take a more riskier position than the others. Thus, whenever there's a market turmoil, it is always those with the most riskiest position, they will then be the one that will start to liquidate first. So their liquidation will create losses for people down the chain. And the next group will hit the margin call, and they will have to sell more things, sell more assets, stocks or bonds or currencies, whatever they are holding on leverage. And this just keep going on and spiraling downward, creating a domino effect. So now that we have covered the basics of the yen carry trade and its historical context, I would like to take a moment to test your understanding with a quick quiz. So this will be fun, right? It'll be a great way to make sure that we are all on the same page. Please take a moment to look through the question. Okay, maybe I'll just read out the questions and the answers, choices of answers given, and you can choose one that is you feel the most accurate. What is the main risk associated with the yen carry trade? So is it number one, interest rate fluctuations in the United States? Or number two, it is leverage, which can amplify losses? Or is it number three, the rising value of global equities? Or is it the last option, that the yen will remain weak for an extended period? Okay, a couple of more seconds and we will end the poll. Okay, let's review the question and the answer. Give me a moment while I restart my slide. Okay, I hope you can see my screen again. What is the main risk associated with the yen carry trade? The correct answer is number two, leverage. So well done for those who got the right answer. The yen carry trade involves borrowing, so which creates a leverage position. So this means that if things go wrong, losses can be magnified, especially if the yen strengthens. Great, great. Let's continue. So now let's focus on how these yen movements affect the Japanese stock market. When the yen is weak, Japan's export-driven companies like Toyota, like Sony, will benefit because their products will become cheaper abroad. However, when the yen strengthens, as it has been recently, it erodes profit margin for these companies and thus will then drive the stock price lower. As investors borrow yen to fund their investments elsewhere, the influx of foreign capital into Japan can lead to increased liquidity in the Japanese financial markets. This liquidity is good, is beneficial for the stock market, and it can contribute to a more vibrant financial sector. And the yen carry trade also tends to weaken the Japanese yen as investors sell yen to buy assets in other currencies. If you recall, the yen carry trade process always starts with the investor borrowing in yen to invest in other countries' assets. So when they borrow the yen, they will then sell the yen and buy into other currencies. So say sell yen and buy USD, exchange it to USD. So then with the USD, they then proceed with their other investment. So the actions of selling yen will cause yen to be weakened. But weakened yen makes Japanese exports more competitive abroad. So this will potentially boost Japan's export-driven economy. And Japan's role in the global financial system is significant due to this yen carry trade. Because the interconnectedness between the yen and the global markets means that any shifts in the Japanese monetary policy can have a ripple effects around the world. So people don't just pay attention to what's going on in their own country or what's going on in US because it's the largest economy, but they also will need to pay attention to what's going on in Japan, right? Because of this yen carry trade. Because any movement in the yen will cause the investors to react by selling the assets and repaying their yen-based loan. So this is particularly prevalent in countries with investors that engage in this kind of a yen carry trades. And also, while the yen carry trade involves borrowing yen to invest abroad, it will also draw foreign investors into Japan. Many foreign investors, especially those from Europe and United Kingdom, have been investing heavily in Japanese stocks because they are taking advantage of the yen's weakness to convert their currency, pound or euro, into yen, and they can then buy the Japanese assets on the cheap. So this influx of foreign capital has been one of the driving forces behind Nikkei's recent high. Take a look at this chart from Reuters. On this chart, it showed that foreign investors made hefty investments in Japanese stocks in 2023. So this is buoyed by optimism around the corporate government's reforms and a weaker yen against the US dollar. Japanese stocks accumulated about 6 trillion yen, which is roughly about USD 43 billion worth of foreign inflows on a net basis last year. So this is the biggest amount since 2014, according to the data from Tokyo Stock Exchange. Overseas investors secure about 3 trillion yen worth of cash equivalents through the yen carry trades and another 3 trillion worth of stock index futures last year, breaking a 3-year long selling streak. And the flow of foreign money into Japanese stocks were mainly driven by investment from the United Kingdom, as well as from South China and South Korea and from China. European investors are the main driving force. An analysis of Finance Ministry data shows that there are net purchases of about 8.7 trillion yen for Japanese stocks. This includes fund holdings and exchange traded funds and stocks. And this is net purchases happens to come from European investors between April last year to January this year. This accounts for the vast majority of the net buying by foreign investors according to the data. UK was the clear leader last year, 2023, as investors there bought an average of 800 billion yen worth of Japanese stocks every month, soaring, and this is a huge increase from a monthly average of only about 7.5 billion yen from April 2018 to March 2023. So prior to that, the 5 years prior to last year, the average is only 7 billion. But last year it ballooned almost 100 times, more than 100 times to 800 billion. And this increase stems from oil money. The City of London, the UK's financial hub, has had a deep ties with the Middle East since the 1970s, playing a big role in the global spread of money from that region. And London hosts offices of sovereign wealth funds like Saudi Arabia's Public Investment Fund and Kuwait Investment Authority. And Japanese stocks are appealing to them, in part because of their relatively cheapness given the yen's depreciation against pound. We can see this being played out through our observation on the correlation between Nikkei 225 and the pound yen currency pair. Over on this chart, Nikkei 225 is the line in blue. The pound yen currency pair is the line in red. So over the past 4 years, from 2020 to 2024, both the pound yen and the Nikkei 225 have shown substantial upward trends. The chart below, the chart shown here, indicates a close correlation between these two financial assets, particularly from late 2022 to mid 2024. The pound yen in blue, the pound yen in red and the Nikkei 225 in blue have both risen significantly over the observed period, with the Nikkei 225 reaching a recent peak of around 40,500 and the pound yen climbing to approximately 204. There are notable periods where the movements of the currency and the index, the stock index, they are so closely aligned, suggesting a strong correlation between the two. And this is particularly evident from the late 2022 onwards, where both the assets exhibit synchronized peaks and troughs. The Nikkei 225 has experienced periods of high volatility with sharp rises and falls, particularly last year, 2023. A strong pound yen can indicate an increase in purchasing power for the British investors, enabling them to invest more heavily into the Japanese stocks. So currency strength often reflects broader economic sentiment as well. A rising pound yen can signal confidence in the UK economy, encouraging investment in higher yielding assets like the Japanese stocks. Conversely, a weaker yen can make the Japanese exports more competitive, boosting corporate profits and thereby positively impacting the Nikkei 225 stock index. So we can see here that the fluctuations in the pound yen can influence global risk appetite. A stronger pound against the Japanese yen might indicate a shift towards riskier assets, including equities in robust markets like Japan. And the flip side is equally true as well. So far, we have established the importance of the strength of Japanese yen to that of Nikkei 225, especially that of yen relative to British pound. So next, let's look at some other economic metrics, which may draw some light to our understanding in the outlook of the Japanese yen and that of the Japanese stock index, in particular the Nikkei 225. On 31st of July, after a two-day policy meeting, the BOJ said that it will guide the uncollateralized overnight call rate to 0.25% from between 0 to 0.1%. So this was the second rate rise this year, following the one on 19th of March, when it lifted a negative interest rate policy and ended equity purchases and yield curve controls. BOJ Governor Kazuo Ueda stressed that the rate hike was meant to address the risk of inflation. As shown here on the chart, in somewhere around December 2022, Japan's inflation rate breached its 4% mark, a level it hadn't seen since 1990. So you can imagine their reaction, right? For the past 30 years, it has been low, and then suddenly it spiked up within a short period of time to the peak that it has only seen in 1990. Well, the rate has since fallen from the peak, but data shown that it had been picking up slightly since January this year, up to, as of the last report in August, 3%. In, in a separately released economic outlook report, the BOJ projected that the consumer inflation would be around 2.1% next year and drop further to 1.9% the following year in 2026, indicating that they're expecting the consumer prices to be on track to come down to achieve their target of 2% on a sustained basis. So for as investors, this then become important data for us to keep watch on, which is on the trend of the inflation. Because if inflation continues spiking up, especially if you breach above 4% again, we are sure that the BOJ will start to react by increasing the interest rate, which will may or may not create another shock to the yen carriage rates. But if it start to taper down and start to fall in line with this BOJ's projection, which is about 2.1% next year, and then 1.9% the following year, then there's a chance that the further rate hike will be low. So the next 6 months, this is the data that we probably need to keep a close watch on. The next chart compares Japan's coincident index with the performances of Nikkei 225. Coincident index is a statistic that tracks the current state of the economy by measuring the simultaneous movement of multiple economic indicators. It is more robust than just looking at gross domestic product. As apart from GDP, the index also composed of industrial production, personal income, and retail sales. And these indicators are often called real-time data because they provide information about the current state of the economy. No single indicator is enough to fully understand the complex economy. So to better understand the economy of Japan, coincident index is often used in conjunction with the composite leading indicator, or CLI in short. And unlike coincident index, CLI predicts future economic directions. It is based on 12 economic indicators and provides early signals of turning points in business cycles. So to summarize, coincident index reflects the economy's current status, what's going on now. And the composite leading index, CLI, is usually used to predict the future economic directions. And it's usually projection around a few months ahead, 3 to 6 months ahead of the composite index. So we can see that based on the CLI, the economic activities over the next few months is not looking too strong for Japan. And with that, I think that if the economy is going to follow this track as laid out by CLI, then the chance of the BOJ raising rate further is low as well, because they're going to end up causing the economy to weaken if they continue to raise the rates while the indicator already pointing to a weakening economic strength. And lastly, the best barometer for measuring the strength of the economy and in explaining the performances of stock market is perhaps the unemployment rate. On this chart, the black line is the inverted chart of Japan's unemployment rate, and the blue line is the monthly chart of Nikkei 225. So we can see obviously that there's a strong correlation between the two since 1990. And I mark now some arrows for you to pay attention to. The red and the green arrows show the major peak and trough of the unemployment rate, which were also the major turning points for the Nikkei 225. Nikkei has managed to claw back most of its losses after the August 5th brutal sell-off that saw the index shed about 12.4%. Nevertheless, investors should watch out on how Japan's unemployment rate plays out over the next 6 months. Unemployment rate higher than 3% may have a negative impact on the stock market. So now, time for our next quiz before we move on. And this one is about how a weaker yen will impact Japan's economy. So the question is, please give a moment as we pull out the poll. The question is, what is one key benefit of a weaker yen for Japan's economy? If you know the answer, you can select it now. Okay, I'm just going to read through the answers for reference. Okay, what is the one key benefit of the weaker yen for Japan's economy? Is it number one, for its cheapest import for Japanese consumer, or is it that it boosts the tourism as travel gets more affordable for visitors? Or is it that it lowers value of Japan's foreign currency reserve? Or is it because it raises the cost of Japan's export? Okay, just give you a few seconds to choose your answer. Okay, we shall end the poll. Okay, thank you for your participation. Let me just share my screen again. Okay, so what is the one key benefit of a weaker yen for Japan's economy? Okay, the correct answer is number two. A weaker yen will boost tourism by making Japan more affordable for foreign investors. Right, that is why so many people like to visit Japan nowadays, right? Because it's relatively cheaper, right, as compared to a few years ago where the currency is much stronger. So in addition, it also helps exporters by making the Japanese goods more competitive globally. Lastly, right, the most practical tool of all, I find, for trading Nikkei 225 is to follow what the forex market is doing on pound yen. On the chart here, you have a comparison of a daily chart on the Nikkei 225 futures on top and that of the pound yen at the bottom in red. Such intermarket analysis is commonly used as a supporting signal on the direction that the primary market, in this case Nikkei 225, will take. The chart here demonstrates how by using a simple trend line, traders are able to pick up signals from the pound yen to trade on Nikkei 225 futures. For example, on the 17th of July, the pound, just give me a moment. On the 17th of July, the pound yen trended down and closed below the blue trend line. Traders can then follow the signal and they could have just sold Nikkei 225 on that day at a close around 41,000 points. The index then fell 10,000 points to close at 31,000 on the 5th of August. So that's about a 5 million yen profit on a single trade on for one contract of Nikkei 225. 5 million yen is about 34,000 USD. And then we see again on the 13th of August, after Nikkei 225 rebounded strongly from 31,000 to about 36,200 points, we got a buy signal when the pound yen closed above the blue trend line, another blue trend line. And the up move wasn't as strong as the previous one because it has already rebounded quite strongly before the signal come. But the index did manage to continue to edge up until about somewhere on the 3rd of September, when the sell signal on the pound yen had triggered the trade a signal for the traders to reverse their trades. So the trader who bought here, he would have sold his position and then add on another sell and to switch his long position to a new short position on the Nikkei 225 when the index was trading at 38,700. And this trade yielded a smaller profit of about 1.25 million yen, which is not too shabby, still about USD 8.5k, 8,500 per contract. And next, lastly, after the traders sell the trade, they get another signal on the 16th of September, whereby the pound yen once again triggered a signal for the trader to reverse out of their short position and initiate a fresh long position on the Nikkei 225 futures at about 36,000 points. And as of now, the index is trading somewhere around 38,000, right? The long position is still in play. So this is just one technique that we can use, the traders can use, which we call the intermarket analysis, to use the movement of one asset or one product to signal the trade into another product. So I would like to take this opportunity to highlight my work and services. I'm a triple licensed representative specializing in stocks, futures, forex, and unit trusts. I have been with Philips since 2004 and had over 20 years of experience investing in the financial markets. My clients benefited from my services, which include investment advisories in unit trusts and stocks, investment insights based on my personal knowledge and experiences navigating through the markets the past 20 years. And this is the list of WhatsApp and alert services I provide. On top of that, my clients who are keen to learn about fundamental technical analysis can also talk to me to arrange for a one-on-one coaching session conducted on Zoom or face-to-face. And before we wrap up, one good news to highlight to you is that we have a special promotion by Philip Nova from now until November 30th this year, 2024. You can trade the SGX or the Osaka Nikkei futures at a lower commission rates. And on top of that, you stand a chance to win a pair of tickets to Japan. So you can scan this QR code shown on your screen to learn more about this promotion. If you'd like to get in touch, here's my contact information. You can reach me via email or phone, and also you can feel free to connect with me on LinkedIn, or you can scan the QR code. Also, if you are keen on a one-on-one coaching session, you can contact me here. Okay, we have covered a lot of ground today, and I hope you found this valuable. So now we open the floor for questions. Please feel free to type your questions in the chat and I will address them. Okay, I see some questions here. Someone is asking, is my coaching service free? Yes, is free, right? The WhatsApp services I've shown here is also free, but those are for my clients. The next question is, do Philip provide demo account to try? Is it free? Yes, we do provide a demo account, but our demo account for our platform, we have two platforms here, the Nova platform and MT5. For Nova platform, the demo account is more for you to familiarize with the platform. There's no paper trading available. But for MT5, if you're interested to trade the Forex and CFD, it does has paper trading function in it that you can try and put on some trades. The next question is there a maintenance fee for account application? No, there's no maintenance fee. You can open the account to get started, but if you don't place any trades, there is no fees involved until you start to trade on the products. How much to open account? There's no cost to open account. But if after open account you decide to trade certain products like the pound yen I mentioned or Nikkei 225, then you need to make sure to have that you'll be sufficiently funded because the products that we trade on is traded on margin. So you need to make sure that you have the sufficient margin to be able to place the trades. But as mentioned, if you open an account and you haven't placed any trades yet, you do not need to fund in until you are ready to place your trades. Next question is, do Philip charge a platform fee? No, we do not charge any platform fee. The fees will only be from the commissions when you place the trades on futures products. And also, maybe if you were to trade Forex products or CFD products, then there will be swap point charges if you hold a position overnight. Okay, I think I've answered most of the questions. If you thought of any more questions after today's session, please feel free to reach back to us via email or through our contacts. That's all the time we have for today. Thank you so much for being a wonderful audience for tonight's webinar. A link to the recording for this webinar will be made available in our follow-up email tomorrow. If you have any query on the webinar or would like to get started, simply reply to our email and we will get in touch with you. This is Eric Lee signing off, wishing you a great success in your investment journey. Good night.